We are covering these 7 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on SOUN. SoundHound AI Incorporated is making big moves in the voice AI space, and the latest update should catch the attention of investors. The company, which specializes in conversational AI, has expanded its partnership with tech giant NVIDIA by integrating NVIDIA AI Enterprise into its platform. SoundHound is taking its voice AI technology to the next level. This integration promises to accelerate real-time AI processing, making their solutions faster and more efficient across industries like automotive, customer service, and even restaurants. What's really interesting here is how this partnership is improving the responsiveness of SoundHound's technology. With NVIDIA's microservices like NIM and NeMo, the company can now offer lower latency processing, which is key for any application that relies on quick, real-time responses. For instance, this could make in-vehicle voice assistants more responsive, as seen in their collaboration with Lucid Group, where SoundHound's AI is integrated into Lucid's in-car systems. Despite these advancements, there's some tension around the stock, with short interest on SoundHound shares increasing to about 32.9%. This signals that some investors are betting against the company's growth. However, the CEO is confident, calling this volatility a sign of disruption in the AI space. He believes that short interest just makes the potential for success even sweeter, suggesting that the company is focused on long-term growth and innovation, especially with its new AI capabilities. For investors, this could be a key moment to keep an eye on SoundHound. The partnership with NVIDIA is a strong signal that the company is solidifying its position in the fast-growing voice AI market. If the company can maintain its technological edge and expand its customer base, we might see strong growth in the future, despite any short-term market fluctuations. Our review on PTON. Peloton Interactive Incorporated has been making waves in the fitness space, but recent developments are raising some eyebrows for investors. Known for its connected fitness platform, Peloton has built a global community of over 6 million members, offering everything from high-end exercise equipment like bikes and treadmills to on-demand and live fitness classes. The big news here is Peloton's push to refine its business model, especially after a period of rocky sales and shifting consumer habits. The company has been heavily focused on its 2 main segments: connected fitness products and subscription. The product side of the business, which includes the Peloton Bike, Tread, and now Peloton Row, has faced some challenges with pricing and demand, but the subscription side is where Peloton's real potential lies. Subscriptions, offering access to Peloton's ever-growing library of live and on-demand classes, are the steady revenue stream the company needs to depend on long-term. Lately, Peloton has been adjusting its strategy, with some moves that could signal a renewed focus on profitability. For one, the company has been shifting away from its past emphasis on acquiring new members at all costs and focusing more on retaining the ones it already has. This is key because as Peloton's subscriber base stabilizes, the company can rely more on the recurring revenue from its subscriptions. This shift in focus comes at a time when Peloton's equipment sales have slowed, likely due to the post-pandemic shift in fitness habits. Now, with its expanded content offering like the Peloton Row and a deeper commitment to keeping current users engaged, Peloton might be primed for a solid rebound. The focus on content and community engagement over raw sales of physical products could help the company regain investor confidence, especially if it can prove that its subscription model can deliver sustainable long-term growth. Investors should keep an eye on how Peloton navigates these shifts. With a solid brand, a strong community, and a clear focus on content, the company's potential. Our review on BMY. Bristol-Myers Squibb Company, a major player in the biopharmaceutical world, has been making some waves recently, especially with its diverse portfolio of life-saving drugs across oncology, hematology, immunology, and more. This global biotech giant has been in the forefront of treatments for serious diseases, and with drugs like Opdivo, Yervoy, and Eliquis, it's clear that their reach in the industry is substantial. Recently, there's been a noticeable uptick in call options activity surrounding Bristol-Myers Squibb, which has got investors buzzing. The volume of calls is about double what's typically expected, and the implied volatility has risen a bit, signaling that market sentiment is leaning bullish. So what's behind this? Well, a big part of this movement could be tied to upcoming earnings, expected on April 24th. The fact that the most active options are betting on a jump in the stock price, with calls at the $67.50 and $60 strike prices for May and March respectively, suggests that investors are optimistic about the company's near-term prospects. Bristol-Myers has been making strides with its portfolio, particularly with treatments like Opdualag, which combines Opdivo and relatlimab. This could be a game-changer in cancer treatment, and with the success of other drugs in their pipeline, the company is definitely positioned well for future growth. So, while the increased options activity points to some optimism in the short term, it's really about whether Bristol-Myers can continue to capitalize on its strong portfolio and pipeline to maintain that momentum. If they deliver on their earnings and the market likes what it sees, we could see the stock continue to climb. Of course, any surprises in the earnings report or unexpected challenges in their drug development could throw a wrench in that. But for now, the market is betting that Bristol-Myers is in a good spot. Keep an eye on those earnings. They could be the catalyst for whatever direction the stock takes next. Our review on RIOT, Riot Platforms Incorporated, a company known for its Bitcoin mining operations and digital infrastructure, is making some big moves lately. The company operates mining sites in places like Central Texas and Kentucky, and it's also involved in designing and manufacturing electrical power distribution equipment. Riot is building a solid platform that combines Bitcoin mining with engineering solutions, which sets it apart in this rapidly evolving sector. Now, let's dive into a recent development that's got investors' attention. Riot announced a major step forward by entering into a non-binding term sheet to acquire certain assets from Rhodium Enterprises, a big name in the Bitcoin mining space. Not only that, but Riot also revealed a settlement agreement that will lead to the dismissal of all existing litigation between them and Rhodium. This is a significant move because it clears up any legal hurdles and sets the stage for a smoother path ahead, especially in terms of growth and potential synergies between the two companies. For Riot, this acquisition could bring a host of benefits. It's not just about expanding its Bitcoin mining capacity. It's about consolidating assets and gaining access to a larger share of the mining market. The deal could also bring some much-needed operational efficiency as Riot aims to scale its platform and bolster its position in the competitive landscape of cryptocurrency mining. The dismissal of litigation is another positive sign for investors, signaling that the company is resolving past issues and focusing on future growth. Investors love a clean slate, and Riot's legal troubles being put behind them can only make the company's stock more attractive moving forward. This development could serve as a catalyst for the stock price, particularly as the Bitcoin market shows signs of volatility and growth potential. So, for anyone watching Riot, this settlement and acquisition could be just the beginning of a more streamlined and profitable future for the company. Keep an eye on how this plays out, as it could have significant implications for their operations and stock performance in the coming months. Our review on META, Meta Platforms Incorporated, the tech giant behind Facebook, Instagram, WhatsApp, and a range of virtual reality products, has always been in the spotlight for its cutting-edge developments. The company is pushing forward in big ways with its family of apps, which continues to grow and evolve, and its Reality Lab segment, which is taking us into the future with VR and AR innovations. Now, Meta is making waves with some fresh news that could have a big impact on its stock performance. The company is reportedly eyeing a potential alliance with Reliance Industries, one of India's largest conglomerates, which could open up a whole new chapter in its AI and business development efforts. This isn't just a casual partnership. Meta is looking at ways to collaborate on new AI businesses that could reshape how its products work and expand their reach in the Indian market. But there's an interesting twist. OpenAI, the creator of ChatGPT, is also in talks with Reliance about a similar kind of partnership. So, Meta and OpenAI are essentially eyeing the same player, which could lead to some competition between these tech powerhouses. The way this all plays out could have serious implications for both companies, especially in terms of AI-driven solutions and how they're integrated into global markets. For Meta, this potential deal could unlock huge opportunities, especially with Reliance's massive business units, including its wireless carrier Geo. The collaboration could help Meta expand its AI capabilities, furthering its push into new technologies and markets. With Meta's heavy focus on the metaverse and virtual reality, teaming up with a major player like Reliance could provide the kind of boost the company needs to accelerate its vision and product offerings. Investors should keep a close eye on this one. A deal with Reliance could position Meta to make stronger inroads in the growing AI market, and with the tech industry's eyes already on the company's next moves, this partnership could help catapult Meta into the next phase of growth. If it works out, it could be a major catalyst for stock movement, but with competition from OpenAI, it's a space that will definitely be worth monitoring. Our review on SONY, Sony Group Corporation, a powerhouse in entertainment and technology, has been making waves lately. With its diverse portfolio covering everything from gaming and music to imaging solutions and financial services, Sony has its hands in a lot of industries. But it's the gaming side of things that's catching the most attention right now. The big news? Sony's latest PlayStation 5 exclusive, Astro Bot, has sold over 2.3 million units. That's a huge number, especially considering it's a new release in 2024. What's interesting is how the game gained momentum after it won Game of the Year at the Game Awards in December. Initially, sales had started to plateau after hitting 1.5 million in November, but the award gave Astro Bot a major boost, sparking renewed interest and pushing it past the 2 million mark just weeks later. For investors, this is a great sign. Sony has been on a roll with its gaming division, and Astro Bot's success shows that there's still massive demand for PS5 titles. With 2.3 million units sold and counting, it's clear that Sony's gaming strategy is resonating with consumers. This could be a big contributor to overall growth in its games and network services segment, which has been one of its top performers. Beyond just game sales, this success also highlights Sony's strength in leveraging its exclusive titles to drive hardware sales and subscription growth, further solidifying its position in the gaming industry. So, for investors watching Sony stock, this is definitely something to keep an eye on. Strong game sales are a clear indicator of the company's ability to continue generating revenue and capturing market share in an increasingly competitive space. If this momentum keeps going, we could see even more positive movements in Sony stock in the near future. Our review on IONQ. IONQ Incorporated is at the forefront of the quantum computing and networking industry, delivering some of the most advanced quantum systems in the market. With their IONQ Forte and IONQ Forte Enterprise systems, boasting 36 algorithmic qubits, they're pushing the envelope in a space that's still evolving but has massive potential. Beyond just building cutting-edge hardware, IONQ has made its quantum computing power available through major cloud platforms like AWS, Azure, and Google Cloud, providing access to quantum computing as a service, QCS. Now, recent news surrounding IONQ might raise a few eyebrows among investors. Despite a nearly 50% drop in stock price this year, which has some investors concerned about the future of quantum computing, there's been an interesting move from within the company. IONQ board member Bill Scannell just made a significant purchase, $2 million worth of IONQ stock, snapping up over 93,000 shares at an average price of $21.81. Scannell, who's also the president of global sales at Dell Technologies, now holds a personal stake in IONQ, signaling confidence in the company's long-term prospects. For investors, this could be a strong signal. The fact that a key insider is betting on IONQ at this dip could suggest that the downer might be temporary and that there's still belief in the company's potential, especially in the growing quantum computing space. Remember, stocks in emerging tech fields like this can experience a lot of volatility, but insider buying during a dip often suggests that those closest to the company see value even at lower prices. It's also worth noting that IonQ stock saw massive growth in 2024, tripling as investors got excited about quantum computing's future. While the stock has pulled back this year, the fundamentals of the company remain strong, and this insider purchase could be an indication that the downer might be an opportunity rather than a signal of deeper trouble. For those keeping an eye on IonQ, this could be the moment to reassess the stock. With quantum computing still in its early stages, there's plenty of room for growth if IonQ can keep delivering on its promise and scale its technology. This insider move might just be a sign that it's still a long-term play. Please subscribe, give the video a like, and watch more from our playlist. Thanks.